The checks are coming, and they're bigger than most people realize. While millions of seniors across America are going about their daily routines, a significant payment update just cleared federal approval that's about to change November for Social Security recipients. We're talking about $2,400 hitting bank accounts in the first week of next month, and the timing couldn't be more critical with rising costs squeezing retirees harder than ever. Here's what's actually happening behind the scenes. The Social Security Administration has finalized payment schedules that include cost of living adjustments and supplemental payments that many eligible seniors don't even know they qualify for. This isn't about rumors or speculation. These are confirmed direct deposits based on your birth date and when you started claiming benefits. But here's the catch: not everyone will receive the same amount, and some seniors might miss out entirely if they don't understand how the payment structure works. The next 60 seconds could determine whether you're prepared when that deposit hits. Let's break down exactly who gets paid when, how much you should expect, and the 3 critical things you need to verify in your account right now to avoid any delays or surprises. Let me be completely transparent with you right from the start. The Social Security system operates on a schedule that's been refined over decades, and understanding this schedule is absolutely essential if you want to know exactly when your money arrives. Now, when we talk about $2,400 deposits hitting accounts in early November, we need to understand that this figure represents the maximum potential payment that certain recipients will receive based on multiple factors, including your lifetime earnings, the age you started collecting benefits, and whether you qualify for any supplemental programs. This isn't a one-size-fits-all situation, and that's actually important to grasp because it means your specific payment could be different. But knowing where you stand in a system gives you complete control over your financial planning. The Social Security Administration doesn't just randomly send out payments whenever they feel like it. There's a methodical system in place that's been designed to ensure tens of millions of Americans receive their benefits reliably every single month. The payment schedule is tied directly to your birth date, and this is something that confuses a lot of people because they think everyone gets paid on the same day. That's simply not how it works. If you were born between the 1st and the 10th of any month, your payment arrives on the 2nd Wednesday of each month. If your birthday falls between the 11th and the 20th, you're looking at the 3rd Wednesday. And if you were born between the 21st and the end of the month, your deposit comes on the 4th Wednesday. But here's where it gets interesting for November specifically. There are additional payments and adjustments that some recipients will see stacked on top of their regular benefits. And this is where that $2,400 figure comes into play for maximum earners. Now let's talk about what's actually changing and why this matters so much right now. The cost of living adjustment that was approved for this benefit year represents one of the most significant increases we've seen in recent times. This adjustment isn't just some arbitrary number that bureaucrats pulled out of thin air. It's calculated based on the Consumer Price Index, which tracks the actual costs of goods and services that everyday Americans purchase. The government looks at everything from groceries to utilities to healthcare costs, and they use this data to determine how much benefit amounts need to increase to keep pace with inflation. For someone who's been receiving Social Security for years, you've probably noticed that your payments have gradually increased over time. But the adjustment we are seeing now is particularly noteworthy because it reflects the economic reality that seniors have been facing with dramatically higher prices across the board. The maximum Social Security retirement benefit for someone who retired at full retirement age is currently sitting at approximately $3,800 per month. But very few people actually receive this maximum amount. The $2,400 figure we are discussing represents a substantial monthly payment that applies to a significant portion of recipients, especially those who had consistent earnings throughout their working careers and waited until full retirement age or later to start collecting benefits. If you started collecting early at age 62, your monthly benefit is permanently reduced compared to what you would have received by waiting until your full retirement age of 66 or 67 depending on when you were born. On the flip side, if you delayed taking benefits past your full retirement age, you earn delayed retirement credits that increase your monthly payment by 8% for each year you waited up until age 70. This is why two people who work similar jobs and earn similar wages throughout their careers can end up with vastly different Social Security payments. Let's dive into something that a lot of seniors don't fully understand, and that's the concept of combined benefits and supplemental payments. If you're receiving Social Security retirement benefits and you also qualify for supplemental security income, also known as SSI, your total monthly payment can be significantly higher than your base retirement benefit alone. SSI is a needs-based program designed for individuals with limited income and resources, and it's administered by the Social Security Administration even though it's funded through general tax revenues rather than Social Security taxes. The current maximum federal SSI payment is over $900 per month, and when you combine it with retirement benefits, you can see how the numbers start adding up. Additionally, some states provide supplemental payments on top of the federal SSI amount, which can push your total monthly income even higher. This is particularly relevant for seniors who worked but didn't earn enough throughout their careers to qualify for substantial retirement benefits on their own. Here's something crucial that catches people off guard every single year. When your payment date falls on a weekend or a federal holiday, the Social Security Administration actually deposits your money on the last business day before that weekend or holiday. This means that for November, if your scheduled payment date happens to fall on a Saturday, Sunday, or holiday, you'll actually see that money in your account earlier than you might expect. This advanced payment schedule can be a pleasant surprise if you're not aware of it, but it can also throw off your budgeting if you're not paying attention to the calendar. The first week of November is particularly interesting this year because of how the payment schedule aligns with the calendar, and this is why we're seeing an increased focus on those early November deposits. Now I want to address something that causes a tremendous amount of confusion and sometimes even panic among Social Security recipients, and that's the difference between gross and net payments. When the Social Security Administration calculates your benefit amount, they're determining your gross benefit, which is the total amount you've earned based on your work history and the age you started collecting. However, what actually hits your bank account is your net payment, which can be lower than your gross benefit for several reasons. If you're enrolled in Medicare Part B, your monthly premium is automatically deducted from your Social Security payment. For most people, this premium is over $170 per month, but it can be higher if you're in a higher income bracket due to something called Income-Related Monthly Adjustment Amount, or IRMA. Additionally, if you have federal taxes withheld from your Social Security benefits, that comes out before the money reaches your account. Some people also have other deductions like garnishments for unpaid federal debts or court-ordered obligations. This is why it's absolutely essential to look at your Social Security statement and understand exactly what your net payment will be rather than just focusing on the gross benefit amount. Let's talk about verification and making sure you're set up to receive your payment without any hiccups. The vast majority of Social Security recipients receive their benefits through direct deposit, and this is by far the most reliable and secure method. If you're still receiving paper checks, you need to understand that the Social Security Administration strongly encourages and in many cases requires electronic payment. Direct deposit means your money is available in your account on your payment day without any delays from mail delivery or potential issues with lost or stolen checks. To verify that your direct deposit information is correct, you should log into your My Social Security account on the official Social Security Administration website. This online portal allows you to see your payment history, verify your bank account information, and check your benefit amount. If you've recently changed banks or updated your account information, make absolutely certain that the Social Security Administration has your current details, because sending a payment to a closed account can create delays that take weeks to resolve. One aspect of Social Security payments that doesn't get discussed enough is the impact of continuing to work while receiving benefits. If you're under your full retirement age and you're still working, there's an earnings limit that can affect your benefits. For the current year, if you earn above a certain threshold, the Social Security Administration will withhold a portion of your benefits. Specifically, they withhold $1 in benefits for every $2 you earn above the annual limit. This doesn't mean you lose that money forever, though. Once you reach your full retirement age, the Social Security Administration recalculates your benefit amount to account for the months when benefits were withheld, effectively giving you credit for those withheld amounts through a higher monthly payment going forward. However, once you reach your full retirement age, you can earn as much as you want without any reduction in your Social Security benefits. This is a critical distinction that affects many seniors who continue working part-time or who start new careers in retirement. The coordination between Social Security and Medicare is another layer that significantly impacts your overall financial picture. When you turn 65, you become eligible for Medicare regardless of whether you're collecting Social Security retirement benefits. If you're already receiving Social Security when you turn 65, you're automatically enrolled in Medicare Parts A and B. Part A, which covers hospital insurance, is premium-free for most people because you or your spouse paid Medicare taxes while working. Part B, which covers doctor visits and outpatient services, does have a monthly premium. And as I mentioned earlier, this is typically deducted directly from your Social Security payment. If you don't want Part B coverage because you have other insurance, you need to actively decline it, otherwise you'll be enrolled automatically and the premium will be deducted from your benefits. Understanding this coordination is essential because it directly affects the amount of money that lands in your bank account each month. Let's address a concern that comes up frequently, and that's the question of whether Social Security benefits are taxable. The answer is that it depends on your total income. If Social Security is your only source of income, your benefits generally aren't taxable. However, if you have other income from sources like pensions, retirement account withdrawals, investment income, or wages from work, you might have to pay federal income tax on up to 85% of your Social Security benefits. The exact amount that's taxable depends on what the IRS calls your combined income, which is your adjusted gross income plus any non-taxable interest plus half of your Social Security benefits. If your combined income exceeds certain thresholds, a portion of your Social Security becomes taxable. This is why some seniors choose to have federal taxes withheld from their monthly Social Security payment rather than facing a large tax bill in April. You can request voluntary withholding by completing Form W-4V and submitting it to the Social Security Administration. The appeals process is something every Social Security recipient should be aware of, even if you never have to use it. If you believe your benefit amount is incorrect, or if the Social Security Administration makes a decision about your benefits that you disagree with, you have the right to appeal. The appeals process has multiple levels, starting with a reconsideration where a different Social Security employee reviews your case. If you're still not satisfied, you can request a hearing before an administrative law judge. These hearings allow you to present evidence and testimony to support your case. While most benefit calculations are accurate, mistakes do happen, and sometimes circumstances change that warrant a review of your benefits. Perhaps you had earnings that weren't properly credited to your record, or maybe there was an error in how your benefit was calculated. Don't hesitate to question things if something doesn't seem right. And always save your documentation, including payment statements and any correspondence with the Social Security Administration. Looking ahead to what you can expect in the coming months, it's important to understand that your Social Security payment is intended to be a stable, predictable source of income. The cost of living adjustments ensure that your purchasing power doesn't erode over time as prices increase. While no one can predict exactly what future adjustments will be, the formula used to calculate them is transparent and based on objective economic data. As we move through the remainder of this year and into the next, you should receive your annual Social Security statement, which breaks down your earnings history and provides estimates of your future benefits if you're not yet collecting, or confirms your current benefit amount if you are. This statement is an invaluable document that you should review carefully every single year to ensure accuracy and to help with your long-term financial planning.